behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to BTT's special report about the war in Iran. We have been having wall-to-wall coverage all day today, and it continues right now. I have with me is Mish Schneider. She is the chief strategist of MarketGauge.com, as well as the founder of the Economic Modern Family channel on YouTube. Mish, I had to bring you in because you are a commodities trading expert. And when I'm sure, like me, I mean, and everybody else, other traders out there, you probably woke up this morning, you saw West Texas Intermediate hit almost 10% pre-market. Here we are now. We actually have retreated back, and we were expecting a big rally in oil. But how would you trade it at this point? Because I think the reaction is a bit muted.
It is. And when we spoke last Thursday, and by the way, hi, Todd, and hi, everybody. When we spoke last Thursday, we talked about the fact that during the 1990 Gulf War, we woke up to oil at $100 a barrel, and we barely got up to 75, 76 this morning. And last I checked, as we're talking, it's more like 71, $72. And so, of course, we don't know how long this war is going to last and what the disruptions will be to the Strait of Hormuz, which passes 21 million barrels a day of oil. We have OPEC Plus saying that they're going to increase production. And at the same time, we are not in the 70s like I mean, the 90s was one thing, but in the 70s, if we really go back to the last major Middle East skirmish, that was a period of time when we had complete dependence on Middle Eastern oil, and we're not in that situation anymore. We're quite independent, and we haven't even tapped into the strategic reserves that we have here. So if you put that all together, what we talked about even before Iran was the question on, if we have so much oil, that means producers aren't going to drill as much because it's not cost effective with cheap oil. And they win if oil prices go up because obviously their cash reserves get bigger with a bigger profit. And I think that's where we have to focus on, what are these big refineries thinking right now? Are they doing anything different? Do I think they're going to start drilling more because of this? Maybe, but I doubt it. So I think if you're looking just at crude oil right now, of course, we always can go to the chart. And the charts tell us right now that $68 a barrel, looking at the May contract, is super important. If it gets under there, I think we could pretty much say muted. I'm sorry, Tom. Julia. Shh.
That's the mascot, and it looks like Julia is unhappy with the oil price right now. But I'm sure, like you, I mean, I was receiving text messages very early this morning telling me that it seemed that Wall Street traders were all talking, and they were suspecting that we were going to see $100 a barrel of oil by the end of March. Is that unrealistic in your opinion?
Well, I wouldn't say necessarily unrealistic, but it assumes that this war is going to continue. So if we go back to the 1990, that was 6 weeks. Right. And so we're talking about something that could be extended, but we know that everything happens a lot faster. Right. So my guess is there will be some level of resolution vis-a-vis Iran, probably in the next couple of weeks, because Iran economically cannot sustain this war, especially since they depend on oil as their biggest profit center. So my guess is we're not going to see 100. Now, again, let's put the war aside and just say, from a fundamental standpoint, what does that mean for oil? It means most likely that we go back to some kind of trading range, which is really what we've been in, where we have not really been able to see prices much lower than $60 a barrel, because it pops right back up. And 75 was a lot of people, including myself's resistance. So I think you have to trade it in the range theory. If we break out, I'm sorry, is the dog bothering us? Wait, hold on. Can we? All right. All right.
Julia, the dog is not bothering.
She's playing. She's not even 4 months old yet. Come here, Julia.
That's amazing. It's our mascot. Well, while you're taking care of Julia,
is, by the way, sorry.
Oh, that's okay. It's okay. So while you're taking care of Julia there, the question I have for you though is, how would you trade this though? Are you bullish on the big oil companies, for example, because all of them are up. Exxon, Chevron, ConocoPhillips. We actually saw a pre-market price of over 160 for Exxon, which is insanely amazing how it's been trading this year. But are you a proponent on that side, or maybe, I mean, the refiners, the higher, as you know, higher prices for oil really thin the margins on the refiners. But let's say you.
Well, basically, yeah. I mean, there are some oil companies that aren't necessarily participating the way Chevron has. I mean, obviously, if we want to look at, let's say, one of the big bucket holdings, which was Occidental,
Right.
and look at that chart. I mean, that had a nice move today, but now it's coming off the lows. So essentially, here's how I would look at it. I mean, one thing that you have going for you when you get a gap like that, whether it's looking at the actual physical commodity of oil, or you're looking at something like petroleum, or you're looking at Chevron, is once you have that gap, we commodities traders know that you don't want that gap to be filled, right? When a gap is filled, generally that means we're coming to the exhaustion of that particular move. Now, what I would say is I would rather be looking at the underlying always, right? So if we start to see that crude oil in particular, like I said, if it cannot hold today's low and starts to fill the gap and breaks down under 68, then I would imagine the oil companies themselves, you're going to start to see some profit taking there, because the message it's going to relay is, okay, we're back to the fact that oil's not necessarily going to rally and they're not going to necessarily drill. However, if there is some kind of sustained war, then they will drill more, which means it affects their bottom line. Remember, they're in that win-win situation right now because they've had a lot of cash on reserve because they haven't really put a lot of it to work, and they're benefiting off of that and these great profits of oil. So that delicate balance, if they have to start going out and drilling more because they get pressure, because the strategic reserves get drained a little bit, because, you know, obviously our oil independence becomes even more crucial if this thing really goes on, or there's some great damages that takes years to fix, then I don't think that's going to be so bullish for the oil companies either. It might be more bullish for oil itself, but there's a point of departure is really what I'm saying. Right now, they've been in this space of win-win, but that delicate balance could change.
So the president said that he's anticipating this to run 4 weeks. Now, he could just be setting expectations for the American public, because obviously, as Defense Secretary Hegseth said at the 8 a.m. briefing today, that we hit over 1,000 targets in 24 hours. I mean, I can't imagine there's very much left to bomb. So the point being is that if we have this prolonged conflict, let's say we run through the entire month of March, what's that going to do to the price of oil?
Well, again, it depends on what the perception is in terms of the disruption to the oil fields, number one. Number two is, right now, the military is still taking charge in Iran. Obviously, we know the Ayatollah is no longer around. I've heard rumors the president as well. So I think the next question we will go to won't really be a question of oil as much as who's going to run the country and how is that government going to be put together. And if it's not put together, you know, just announcing you, the people, now have control of your own country, you know, we know that that could be pretty anarchy situation, and that would not be necessarily good for keeping oil prices down. So if I had to lean towards the side of, we've done a lot of damage, we're probably going to get this under control, and this is all coming from my sense, of course, then that would mean, again, oil's not going to crash, but it's not necessarily going to go a lot higher. If it breaks over 75, 76, because this thing obviously starts to bring in more countries involved that are oil producers, and we can't open up the Strait of Hormuz anytime soon, then of course we could go back to 85, but I'm not so necessarily certain about 100. Remember, last week our big conversation was about the long bonds, right? And
right.
What long bonds were starting to flash was some kind of a flight to safety. Now, the long bonds have come off a little bit today, and the yields have gone up a little bit in reaction to this. But I still think that what it's trying to tell us, and of course, it's early right here, but I would watch that as a direct correlation relationship to commodities. If the yields fall, even though we always think that that's good for commodities, If it becomes more like the government is going to save the bonds before they save anything else, and that's very possible if there's any other types of situations, and there are other things going on, by the way, besides Iran, then I would say that is not necessarily long-term bullish for commodities. That's why everything is on this delicate pinhead balance. And I think people should be really aware of the volatility and the risk that's involved. And I wouldn't marry any of these positions. We're long natural gas. Obviously, that was nice today to wake up and see it in a profit mode. But again, if Qatar opens up the facilities, and this is just a temporary suspension, and they are, by the way, 20% of the liquefied natural gas exports to Europe come from Qatar, then that'll also put pressure in gas. And then we're back to talking about it as an energy source as opposed to a headline because of supply chain disruption. And I know.
So how are you trading liquefied natural gas then?
I'm not trading that. This is commodities. So let's talk about natural gas. I'm trading natural gas. And if we're looking at natural gas right now, 280 is really key support. We get back through like a 320 level. I think we can even lower it to about 314. That's where the 50-day moving average is. We get through there. What the futures are telling me is that the producers are starting to buy the futures to protect against any kind of longer supply chain disruption. I mean, that's why you always have to think as a commodities trader like that. If there's speculative buying, that's one thing. But if the producers come in and buy, it's because they're worried and they're hedging. And that's why we go back to the oil. If the producers get worried, that's one thing. But right now, they don't seem to be worried about anything. And to me, it seems like if they worry about anything, it would be about the prices going back down. And then obviously even having to make a decision that they continue to sit and do nothing, or they realize that it is a fragile situation and they better start drilling again, which of course affects the bottom line. And I hope that all makes sense.
It makes perfect sense to me, and I'm sure it makes sense to the audience. So we'll wrap up the segment, but I have to ask you though, from an equity standpoint, we've saw a drop in the financial sector. Now we're seeing a rise in defense stocks for obvious reasons. Are you seeking any type of short-term trading patterns, or do you see anything there, maybe within some certain sectors that are there? For example, even travel, Delta taking a huge hit today. But what do you think?
Well, so we have to go to the Economic Modern Family and see what they're saying. And right now, the small caps, obviously, we still have more value in the small caps and more belief that they're going to continue to grow. And they're not going to continue to grow, or IWM is not going to continue to rally without the long bonds, by the way. That's why I'm not certainly thinking, oh, that was a one-day move last week in bonds, and now we're back into a downward cycle and the Fed's going to raise rates. I don't think that. So I look at the small caps, particularly ones with good balance sheets. Transportation is still holding the 50-day moving average. It opened up below, but now it's holding. Another key area to show that we're still feeling positive here in the US in terms of growth. And retail, which would be the third of the inside sectors, also is now, that's had more warning, more of a canary in the coal mine, but held 85 in XRT this morning. If that breaks and we can't sustain the rally in KRE because there's other issues outside of the war with regional banks, there's been a lot of talk about that, more of the cockroach conversation. Again, then I wouldn't necessarily be so bullish in a lot of equities. You have to pick and choose. But I would certainly keep my eye on those bonds. And that's the thing that I have my most focus on right now. I like a couple of stocks. I still like Strategist. I think it's holding well. I like Serve Robotics. I think that's holding well. Overall, I like the vanity trade, although I think you have to sort of stand aside. And the last thing I'm going to mention, since I mentioned it last week, is I really like Ethereum and BMNR here. We had a position. We came in a little bit nervous today, but instead we're getting rewarded. Ethereum came off the highs a little bit, but it's still above 2050. We get through this 2110 area in Ethereum. I think what it's starting to show that not only the down move is over, but that the philosophy has changed to that actually fiat currency is too dangerous. And right now, depending on, and I say fiat, not just dollar, but all around, and that cryptocurrency is probably a much safer bet. I know that's controversial, but that's what I'm thinking right now.
No, I get what I see what you're saying. So with that, and with Bitcoin and Ethereum and any other cryptos right now, Do you think traders or investors are looking at those items as a flight to safety though? Because that doesn't add up.
No, they're not. But I'm saying if we sustain these moves today that we're seeing, this sort of departure all of a sudden in
Yes.
crypto, remember, crypto was really falling apart as of last October, and a lot of it was whale selling, and a lot of it was a lot of regulation that they weren't sure what's going to happen. But the Clarity Act is on the table. And so if the whales are not coming in and buying, and the Clarity Act passes, then it will be a situation where stable coins, real world assets, and particularly Ethereum, as I said, since I really like that as a resource, that's why I like BMNR and what Tom Lee is thinking, will become not necessarily a flight to safety, that may be a strong way of putting it, but certainly showing a departure from the risks in some of the other areas of the market.
So okay, so clearly that's where cash is being deployed, but right now, so and I could see from the trading pattern that makes a lot of sense. Do you think though the move in crypto has anything to do at all with what took place over the weekend in Iran?
Partially, yes. Like I said, I think what people do is they get nervous about investing in anything fiat, if things look vulnerable. And, crypto, obviously, the whole reason for it is DeFi, away from governments, and as a way of blockchain to speed up transactions and have clearly a lot more storage of information on the blockchain, safer. So I think that that's the philosophy that could change, but the Clarity Act would really help a lot too, because now what you have is not just the government, but a lot of banks backing the whole idea. So I think you got to watch for that.
And final question for you. If we do have a prolonged period and we see oil really spike higher, really go higher, obviously with natural gas, then you start seeing you have inflationary concerns. Do you see that being something that's going to really adjust monetary policy with the Fed, especially since they're meeting in a couple of weeks?
Well, again, that's really going to depend on what happens with the labor market. We had the big story last week, of course, was Block getting rid of 40% of their staff because of AI. There was a big report that came out that we're heading into a deflationary cycle because of AI becoming so efficient. So many people are going to lose jobs at number one. And number two is the cost of goods are going to go way down because of AI, because the bottom line of companies will be that they can lower their prices on things because they're not paying a large staff. I mean, it's really, really kind of hard to say at this point, but I'm kind of feeling right now that this super cycle of inflation, I never was fully convinced because my trifecta wasn't there, right? So the dollar is relatively strong. The silver to gold ratio did look inflationary, but it's kind of flipped today with gold still up and silver down. Mm-hmm. And my last barometer was sugar, which basically did nothing. So I'm going to hold out on that sugar right now because sugar is pressing against the 50-day moving average. And if it gets through 1420, we're looking at the April contract on that one, then that might tell you that we're still not out of the woods in terms of inflation. But yeah, I think ultimately the Fed is going to try to do anything they can to number one, counteract that foreign countries don't want to buy our bonds. Number two is that there's a lot of cash that they're putting into the bond market. Number three, they want to make sure that there's no problems with the government. And number four, they don't want to see a real economic slowdown. I think they're going to be much more concerned about that.
Valid point. Completely agree with that. Mish, this was fantastic. I know that your show, Financial Compass, is going to be on a break this week. However, we will be returning next Thursday at 12 noon Eastern. And I know we'll be able to further talk about this war in Iran. Hopefully it will be over by then, but if not, there'll be a lot to discuss at that time. But I do appreciate you joining me today.
Thank you so much for having me on.
Absolutely. So on behalf of Mish Schneider, I am Todd Schoenberger. Thank you once again for joining us on BTT's Breaking Special Report on the war in Iran. We will catch you later. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.
We're the economic modern family. Watch the flow. Market vibes tell you where the trends might go. We're the economic fam, guiding the scene from the streets to the screens to your trading machine. Tap in, stay tuned, feel the beat line, cause the market tells a story through the family line.
There's more happening behind the headlines, and you deserve the full story. At Biz Talk Today TV, we break down investing, government moves, entertainment business, and even sports gambling, all in one place. Real conversations, smart insights, content that helps you think smarter and stay ahead. Thousands are tuning in. Don't miss what's next. Subscribe now to Biz Talk Today TV on YouTube and join the conversation shaping the future.